So traders, welcome to today's module of Forex Beginners class and subsequent modules which we will also be posting. I believe it has all been well all along and you've been understanding and been able to scale your way through in the Forex market, even understand the Forex terms in the Forex market. So without wasting much of our time, let's dive in to talk more about Forex as we go on. See you there. Okay, all right. Welcome back. Today we'll be talking about the Model 2 of to beginners guide in the forex market. So this Model 2 is being majorly on the forex terminologies, the terms in forex where I told you about pips, lot size, leverage, spread, and all that. So first of all, let's dive right in. Okay. This guide explains common forex terms in very simple language so that beginner can understand easily. So some of these common terms are currency pairs, where I explained in the last class that two currency pairs traded together, e.g. Euro USD, whereby the USD comes as the wife and the Euro is the husband, which acts as the base currency and the quote currency. I explained that in the last class. I also explained the PIP, the lot size, the leverage. Then let's talk about the spread. The spread here in forex market is talking about the differences between the buy and the sell of a currency pair. You can also use the word bid or buy of a currency pair. So if you open your chart, you see that green line and the red line on your chart. But in between those two lines, there is a little space between them. That's what we call a spread. It's the difference between the red line and the green line. The green line is called the buy. Is called the sell. Yeah, sorry, the buy rather. The buy, while the red one is the sell price. Another term for the word buy in forex markets, you can also use it another term like long for it. Then for short, for sell, you can use another word like short for it. So when you say long, I'm longing so price like Euro USD, I'm longing Euro USD. It means I'm buying Euro USD. And when I say I'm shorting Euro USD, it means I'm selling Euro USD. I explained stop loss to us in the previous class. I said stop loss is the point whereby you decided that you want to exit the market and accept your loss if price does not go in your favor. Then take profit. I was saying the take profit is the point of it where you decided to go out with the current profit you were having in a trade. I briefly talked about it in the last class. Take profit is that point at which price that was going in your favor decided to give you your profit. Let's say, for example, I took a trade of a stop loss of 10 pips, which is $10, and I target 50 pips to make 50 pips. And the trade has been going in my favor. When it gets to 50 pips, it takes me out. On that 50 pips, I will have $50. It takes me out. That point where I decided to go out of the market is the point where I'm probably looking at that. At this point, price might reverse and go against me. That is why I decided to set my take profit there, which means at that point, I'm satisfied with my profit and will take my money out of the market. Then we have the margin. When we talk about the margin, we are talking about the amount of money needed to open a trade. Going further to explain this margin, I would say let's say $10 account, and we're always using $10 because most of us are small traders, like retail traders. So using a $10 account, your margin there will be like $10 margin. So if you initiate a trade, depending on the current price of the market, you might initiate a trade and one position might take you up to like $2 to $3. So your margin is there to calculate the amount of money which you've used up and the other amount of money that is still remaining that you can use to initiate a trade. That's the duty of the margin, just to tell you, okay, you have out of $10, you have initiated a trade of $2 and you have $8 remaining. So which means if you want to carry out any other trade, you cannot take a trade that's worth more than $8. Then the broker is just like a middleman between you and the forex market. Is a company that connects you to forex market. Remember, I said the forex market is a very big uh, establishment. So the broker is just there to connect you to the forex market, give you the leverage which you use to trade in, like amplify your money that you use to trade. After trading, if you make a withdrawal, your broker will also get a certain percentage from it and then pay you up your money as well. Then speaking about volatility in the market, when we talk about volatility, we are talking about how price move, how fast price move in the market. I'll use gold as an example in this area. We know, maybe most of you might not have known about that, but gold happens to be one of the most volatile pairs in the market, that it can run up to 500 pips in a day. Currently, gold seems to be at 5,000. The price at the ranging from 5,000 to 6,000 thereabouts, if I'm not mistaken. So, depending on how high the price is, that determines the more volatility of it. We might say, gold in a day, gold sometimes run up to 1,000 pips. That's 1,000 or 1,000 more pips daily. As a subsistence trader that is trying to come up, I will also suggest that you stay away from gold. You go to pairs like Euro USD. GBP USD seems is quite okay to trade if you want to trade that. Okay, I would say GBP USD is a stop loss hunter. So when you are trading it, you should give it enough breathing space. Euro USD is just a liquidating market that hunts for liquidity at wherever point it is. You always hunt for liquidity. Then going deeper, we have a trend. So this trend is just to tell you where the market is going. The general movement of the price is either the price is going up or is going down. As we go further, I will teach you how to draw your trend line on your chart so that you know where price is going and how to jump in and follow up the market.